All right. Thanks everyone for joining. I'll get going and people will come in or out as they wish. I'm going to start with a wine inflation hack. And in my emails, I think the most relevant quote I've been hearing for a long time is Howard Marks is good investing is not a matter of buying good things, but buying things well. And if you don't know the difference, then you shouldn't be doing much investing. But I think that can apply to wine as well. You can buy wine, but it's about buying things well. I'm going to show you a little thing right now. Let me share my screen. All right, can everyone see the
Yep.
wine on the perfect? Okay. So this is an example. There's something called wine futures. They're not like commodity futures, but you pre-buy your wine. And wineries do this for cash flow reasons, I think. But in this case, you can see the first one is Chateau Clément, 2024, which will take delivery in 2026 or 27, I forget. You only put a 50% deposit, and the cost is $65 for a bottle. Um, that might seem good or bad, but if you look at Total Wine and More, which if you're a wine buyer, they deliver in certain states, and there's different discounts always here. But you can see that 2018 sells for $150, to 2020 sells for $130, 2019 sells for $200. 2017 to 2021, not a good year, sells for $90, but still $65 to buy it today. So if you want to consume it, it's a great discounted way. You just have to establish these things, obviously, going forward. And I think it's a great way to sort of beat inflation, but still maintain your level of life. Inflation is different for everybody. Rent, for example, is in CPI, but not owning a house. So if you don't have rent, part of that inflation aspect is just eliminated. Or you can make substitutions, and that's not included in CPI. So if you're eating filet mignon every day, you can substitute for hamburger, right? And that takes care of your inflation. However, you're lowering your quality of life. In this case, you can lower your inflation and maintain a quality of life, or even step it up a bit. I recommend Chateau Clément. It's one of my favorite ones, but I can't justify spending $150 a bottle or $200 a bottle, but 65 maybe. It's a little inflation hack. If you like wine, you can start checking it out. And there's different sites and different companies that do it. So if anyone has any questions about that, feel free to ask. Nope. All right. I'll move on to just, I think hedging is still extremely important. I've written an email about that probably about a year ago. I brought it up last time, and I just can't recommend how important I think hedging is, and almost always important. Mark Spitznagel, who wrote the Tao of Capital, his research suggests having a constant hedge on of around 2 to 3% of your portfolio makes no difference if you were to have it or not. So you can drag your portfolio at the expense of a put option is largely indifferent at 2 or 3% of your portfolio forever. If you time it right, it can be wonderful. But here is this screenshot of the S&P 500 in blue, in the blue line, and the VIX, which measures volatility, in the white line. And you can see in April last month, there was a massive spike in the volatility coinciding with a pretty big fall in the S&P 500. If you look here, February 18th and February 18th on the VIX, you can see the VIX was super low, around 15, while the S&P, was extremely high, around 612, 613, all-time highs. This is the best time to buy puts. It's basically car insurance. Going back again to Howard Marks, good investing is not a matter of buying good things, but buying things well. You don't want to buy your put options here when you're panicking. I think I might have told the story. My bikes were robbed out of the parking garage. What's the first thing I did? That day, I bought homeowner renters insurance for the next time it's going to occur. Too late. But this is my life volatility with bike thieves was here, and I went and bought. People were buying put options here. You need to be buying them here, when the VIX is low and the S&P is high, and people think the good times are here to roll. So this is today. So you can see there's a massive gap here. The VIX is back down in the low mid-teens, sorry, and the S&P is again approaching all-time highs. So Howard Marks, his great video, 30 minutes long on risk. You should watch that. He brings up the car insurance example for hedging. You know, it's expense. Car insurance is an expense. So are put options in your portfolio. We have insurance on all sorts of things in our lives. Why not your financial portfolio? Against catastrophic loss insurance, not the, you know, other types of insurance, but it's for catastrophic loss. And so again, things are getting, I think, attractive to add puts if you don't have them already. Roughly speaking, 2 to 3% would be how much to do if you're exposed equity or on risk assets. You don't necessarily have to hedge your cash or treasury bills. You could hedge your gold as well, maybe using GDXJ, for example. Gold doesn't have big enough swings really for the put option volatility to pick up and become valuable. And so one little tool, much like how futures are a tool for the inflation hack of wine, this, I think I brought this up last time as well, this website helps you calculate what your potential returns are. And I just put in GDXJ, for example. If you're not familiar with put options, please feel free to give me a call. We can discuss them and or Google put options. But we'll basically buy some insurance that will go up January 2027. It's a $25 put. That's a strike price. It's currently trading at, GDXJ is currently trading at 70. And so it would have to fall obviously a lot for these puts to start to be worth money. But and you have until 2027 for this to happen. But potentially, if it were to fall, you can see the payoff matrix. There's no reason to do it. It's not, I'm not suggesting you speculate, try to make money from them. You're buying insurance. But if the GDXJ were to crash significantly, so over 50%, which it did in 2020, it did in 2008 and 9, by August, you would, 40 back, again, it's not the reason to buy them. The reason would be to hedge your current portfolio. But that's the sort of tools that are out there and are getting much cheaper right now because, again, the VIX is very, very low. And the markets, in my opinion, is mispricing their risk that the S&P and everything else falls. So I'll leave that there. And again, if you want more information on that, walk through more of an example personally for your portfolio, just give me a call and we can go over it. Stop sharing now, but that's all I really have for today, sort of bigger view. So I'll open up to questions if anybody has some. And I should have a guest speaker next month. So probably Rick Rule, but we'll see how available he is. So go ahead with questions about the wine or puts or gold, silver, macro, anything.
I have a question for you, John, and it is related to buying puts. What is typically the duration of those puts? For how long will you typically receive coverage once you buy them?
I typically buy 1 year to 18 months out. So that would be June of 26, or in the case I just showed, January of 27. So that's 18 months away. Basically, time goes by very fast. There's time decay literally on the value of those options. And you're just always up against the clock with them. There's obviously, if you want to get intricate and watch them every day, you can roll them over monthly, weekly, in some cases, and certainly quarterly, which, there's hedge funds out there that Mark Spitznagel's hedge fund rolls them over quarterly. But, we're just buying basic insurance, none of the bells and whistles of insurance. I'm not, insuring my mirrors on my car or something, right? I'm insuring totaling my car, but more importantly, I'm insuring against hitting, you know, a multi-million-dollar Rolls Royce or something, right? Like that's what I'm insuring myself against. So I just go way out, and I go way out of the money, meaning if GDXJ is trading at 70, I'm buying at 35 or bigger than a 50% drop, because I believe that's where the market is not pricing in that risk, because no one believes it's going to happen.
Right. And in terms of the actual coverage that you get, it's clear that it is recommended to put 2 to 3% of the portfolio. But in practical terms, once let's say a 50% drop happens, what can you expect in terms of percent of your portfolio to be covered, and let's say what percentage of it would you expect to go down in value? Just of course in broad terms.
Yeah, typically it should reduce your losses by half. I think it'd be very broadly speaking. So, you know, if you had $100,000 invested in GDXJ and it went down 50%, so you lose 50 grand, those put options should at least cover half of that. If you just think about 2% of 100,000 is 2,000. If that were to 10 bag, you know, that's $20,000. So that gets you just about half of the fall. So that's a rough way to think about it. Keep in mind, it should be the context. You should be looking at this as a whole portfolio. You should be having cash and gold, along with the hedges and equity, fixed income, perhaps real estate, right? And then hopefully you have some uncorrelated other assets that are going up when the markets are crashing. So from a portfolio perspective, maybe the equities alone are, you're only taking half the loss, but across the entire portfolio, maybe you're only taking, you know, 25% of the loss or something like that. So,
so
I think that's
basically
yeah.
it reduces the losses in half.
Yeah,
That's
just
it.
from a silo of looking at the equities, it should protect half the loss.
Yeah, a half of the portfolio that is
Yeah.
managed by you, right?
Correct. Yes. Yeah.
And finally, in terms of the underlying stock, in addition to GDXJ, do you typically use any other stock?
Yep. So at the S&P 500, I use GDXJ, and I do something else with interest rates, but I do those three specifically. The S&P could disconnect itself from silver miners, for example. Obviously, also you want to hedge what you own. So, you know, if you don't own any S&P, maybe you don't even buy any S&P puts. You know, if 100% of your money is in GDXJ, well, you better hedge that, because there might be a disconnect of what GDXJ does in the S&P. Obviously, in panics, almost everything becomes correlated. And so it doesn't matter per se, but you could imagine a scenario where the S&P is falling. Stagflation might be an example, right? So inflation's going crazy, interest rates are getting cut, but the world is still in recession or depression, and the S&P is falling while GDXJ is taking off. In which case, those puts wouldn't puts on the S&P would be helpful, but GDXJ not. So it first comes down to what are your personal holdings, and then maybe work around some percentage about that, and then hedge what you own. But then also preparing for different scenarios that maybe we're not expecting. So,
thank you.
Yep. All right. Anyone else with a question? Doesn't have to be about puts or wine or anything. You can certainly be about anything else.
No, John, this is Sean.
Hey.
Can you hear me?
Yep.
I was just curious on the diversification of hedging. You know, if like an example, my portfolio is mostly into commodities, and we've got a hedge strategy that taps into the S&P. I get that correlation. Would it also make sense to add a hedge strategy to cover some of the broader, I guess, ownership of commodities? I thought I heard you say well, you might want to hedge, GDX or GDXJ. And so would that make sense for a portfolio that might be heavy with miners and heavy with commodities?
I think the combination of S&P would be good because S&P is probably going to be very correlated with commodities. If the
Okay.
S&P is crashing because of the recession, it's most likely the copper, nickel, oil, and gas, for example, are not doing well. Precious metals can be specifically gold and gold miners might be that one really disconnect from that. Commodities could all take off together as well. We have certainly seen that typically in a crash after interest rates are cut, gold will respond first, followed by gold miners, followed by physical commodities, followed by commodity stocks, and then followed by whatever they were trying to save, right? And so 2008 housing and equities, 2001 equities, that lag from gold and commodities taking off to whatever they're really trying to save is much more pronounced. So, and all that's been getting shortened. So maybe they skip any down in gold because they know what the Fed's going to do. And maybe investors are getting smarter to the behaviors of the Fed, and they might just buy that up and shoot it up. Not in panic, but maybe in a more of a 2008-9 scenario.
Yeah.
So
Would there be a scenario where you might hedge going into an entirely different sector for a longer term play, i.e., real estate or maybe even farmland?
You could potentially try to hedge anything you're going into. Yeah. I mean, it's insurance at the end of the day. It's like, if you buy a car, you buy a motorhome or a motorcycle, you're probably going to hedge that too. So absolutely. Farmland, it's always been historically uncorrelated and extremely stable. Real estate is very regional. Also, is it retail? Oh, sorry, single family housing? Is it apartment complex? Is it commercial real estate? So I don't know how easy it might be to hedge specific parts of real estate. I just haven't looked into it. All I can really think of is VNQ, right, which would be the Vanguard, all world REIT, basically. I think it always makes sense, especially once you've accumulated wealth, right? I mean, if you're in your growth phase, I mean, I'm 45, I still hedge, but certainly if you're retired, you should be relooking over your portfolio, and then two, maybe hedging more, because you can't take a loss once you've made money. You should protect more of it. So it's like starting off with a Toyota and then buying a whatever Rolls Royce or something. Your insurance is more on the Rolls Royce because it has to be. So, and you're protecting greater wealth. So.
Thank you.
Yeah. Anything else, guys? And we'll come up with a more long form initial content. Doug, you got any coffee hacks? Can't hear you, Doug. I know you came off mute, but not sure if you're trying to say something. Doug, yeah. Trying, Doug? Looks like you're trying. You keep coming on and off mute, but nothing's working here. All right.